Don't forget to subscribe to the Retire Young podcast on Apple Podcast, iHeartRadio, and Spotify. Be sure to leave us a review. We like to hear these different reviews, but also if there's different topics that you want to listen to or hear about, leave them in that review, and we'll start to cover that stuff in the show here on the Retire Young radio show. So, Al, you were just talking a lot about how investors can participate in down markets. It's called shorting. So the markets have three directions. They go up. We know that. Mm-hmm. They go down. Most people think that's bad. That's actually a phenomenal opportunity, but they also go sideways. Now, you were talking a lot about retirement accounts, the 401ks and company-sponsored plans that people are participating in, and they're also technically they're managing those without the education and knowledge. Right. Now, we're seeing a lot of people. I mean, we see a lot of people every week, and they're talking about what can I do differently? How can I manage my accounts? How can I take more of a initiative and be able to participate in all these different markets? Self-directing is pretty key for a lot of investors because then they have the opportunity to invest in options. Invest in the futures market, the Forex market, not just mutual funds. Right. Explain what self-directing is, and it's available to anybody. The institutions are doing it.
Sure. Really what it is, it's removing the restrictions on what you have access to. In a 401k, as we've mentioned, typically it's mutual funds, maybe some exchange-traded funds in some cases, maybe some individual stocks, but very few. But again, it is participating only in an up market. With a self-directed IRA, which almost every brokerage firm will let someone set up, actually in your 401ks, you're already managing the assets that are in there. You're making the choices, whether it's the initial choice or whether it comes down to making changes over time. They're already doing that. Why not eliminate the fees that are being paid to somebody just basically to hold the retiree's money there?
That's the key.
While they're making their own decision.
Well, think about this. If there's a company, they're going to say there's going to be we'll say 0.25% or 0.75% management fee, but there's mutual fund fees, there's load fees, front end fees, back end fees. So there's a lot of fees that investors don't even see in those accounts. If you can eliminate those, that's a game changer.
Right. Most people aren't aware of all the fees, and I think unfortunately a lot of people just have assumed the fact that, well, that this is part of being in the market are the fees.
You know what else I hear? We talk to a lot of people and they say, "Oh, I'm okay with paying somebody if they're doing good." Well, if investors learned how to do it, wouldn't it make sense to do it themselves and eliminate the fees? I mean, could that help them? I mean, it's common sense.
Absolutely. Every dollar that is being paid out on a fee is a dollar that's no longer there working for a person, no longer compounding. And the impact of that over time, even with small fees, can be significant. And the bottom line is when someone retires, to have as much available as possible to help them live the lifestyle they want in retirement. And if there's an opportunity to participate in not just an up market, and think about it, if the market it goes down and goes sideways in addition to going up, close to half of the time it's going to be doing something other than just going up. And if a person is not participating in those down and sideways markets, that's almost half of the lifetime missing out on something. And protection is a big part of it too. And that's something that a lot of people don't realize, that you can have protection on a portfolio.
What do you mean, like insure their portfolio?
Like insurance. It's not an insurance policy from State Farm, so don't call them and ask for one. But you can do that with options. A put option is essentially an insurance policy on a portfolio. And that will protect or provide protection in situations where we go through a bear market, for example. The pros, the people that are truly successful, not only are participating in up markets, but they're protecting the profits that they received, and then during a bear market, not losing them, not giving them back. And in fact, they're participating in a potentially profitable manner in a bear market. As you mentioned before, it's just an opportunity in a different direction. It's not a bad market. There really is no bad market. The market is full of opportunities. Sometimes the opportunity is when the market's going up. Sometimes the opportunity is when it's going down, and sometimes the opportunity is when it's going sideways or just range bound, going up and down within maybe the same day or the same week.
Yeah, now think about that. I mean, compounding interest is that they call it the eighth wonder of the world.
Right.
Well, that can be a phenomenal thing for people, but compounding interest can go in a negative way when you have those fees because you're missing out on those gains. So investors, we're seeing a lot of investors realize that and say, hey, I want to take control of this myself. I want to be able to have better financial literacy and just have more knowledge, but also how to take part in different concepts and different techniques. The institutions are doing it. The public doesn't even know that's available. Al, on this show here, we talk a lot about opportunity and the opportunities that are out there, and we know the public just doesn't understand and know that they're out there. Now, let's continue this discussion with the self-directed IRA. There's more opportunity in there because you can invest in multiple asset classes, right? You can invest in futures. You can invest in Forex. You can invest in options. And the public is stuck to one thing. It's that mutual fund. Why is it so important to be more diversified? And how do you hedge? And how are you more diversified by using these other asset classes in your retirement accounts to protect from that downside?
Yeah, several questions there, but
Pick
diversification is a word. I want to talk about that for a minute because a lot of people have been convinced that the protection within their portfolio, whether it's a retirement portfolio or just an investment portfolio, is through diversification. So the Wall Street firms will say, all right, you have to hold multiple equities, for example, to have diversification. Yeah. Maybe in some financial, some healthcare, some technology, some large cap, some small cap, or many different mutual funds that have different objectives. The bottom line is that there's correlation. They're all part of the stock market, the equity market, and when the market is moving, there's correlation that becomes very strong. So in a down market, probably 90%, in a bear market, 90% of the stocks, the equities are going to go down in value. All the mutual funds will follow that. The index funds will follow that. So true diversification is having assets that are not correlated to each other.
Correct.
And that should be part of every investment portfolio, but especially in a retirement portfolio, because that's a time period where a person that has worked 30, 40 years cannot let the money that they have worked so hard for be taken away. Proper diversification will help to hedge the risk in a portfolio. It will give a person the opportunity to be making to have profits or participate in a profitable way in different directions in the market. You can, again, have that insurance policy using options. But proper diversification, maybe it means having some equities, having some currencies, having maybe some real estate, a number of different things that are available to the average investor. But part of, in fact, we have a strategy we call our strategic investor strategy for those people that want to invest their own retirement money, which they're already doing, by the way. But this is a way of being able to have access to kind of a consistent income stream
smorgasbord
that is then used to use those leveraged assets. Right. So that gives you the opportunity to participate in different sectors, for example, or different parts of the market that might be participating in an upward manner when others are participating in a downward manner.
Yeah, that's important to understand. Now think about this. When the stock market is going down, there's some commodities that are going up. That's the futures market. When the stock market is down, there's some currencies, which is the Forex market, that are going up. So now think about this. If investors only want to buy, which is kind of the natural mindset of most people, they can do that in these other asset classes. That way they can be more comfortable if they don't feel comfortable shorting. So that's how true diversification is being correlated or inversely correlated with these other markets.
Correct.
And protecting what you have. That way it doesn't matter which way the market goes, especially in retirement accounts. I mean, it doesn't matter which type of account it is. So, Al, it's getting close to the end of the show here. And we have a lot of listeners that have been introduced to a lot of different terms and different techniques. Al, you got some great words of wisdom. I wish it was something baseball themed, but I'm sure it's not. Let's hear them today.
It's not baseball themed, but I taught one of these classes just recently, and again, someone came up and said, gosh, I wish I'd known this before. I wish I'd done this 20 years ago. It's okay to say that one time. Just make sure it's something you never repeat again. It's not over, it's just time to start doing something different.
And here's the thing, it's never too late. I mean, think about this. If people are in their 40s or 50s or even 60s, I mean, it doesn't matter what age, they're still maybe at halftime or only the third quarter of their life. There's many years to look forward to. This is Josh and Al with the Retire Young radio show. Retire young, my friends.